Hello everyone, welcome to Equity Investing's YouTube course on basics of options. We are now towards the business end of the short-term course. We've seen all about call options, put options, we've learned technical terms, we've understood each and everything. Now let's look at how to place a trade. Now we will spend the next 2 or 3 videos understanding the mechanics of how a trade works, right? Which is also very important. So let's get on with it. I have a simple way of remembering when I first learned options. Call long, call short, put long, put long, short. It becomes very daunting. Okay. So long and short you have to remember. Long means you have to buy, and short means selling. S and S, short, sell, short, sell. Okay, so that's how I remember it. Okay. Call and put, I have an interesting way of remembering. So when you receive a call, you take the receiver up, right? Take it up. So a call buyer benefits when the price goes up, right? After you finish your call, you put the phone down. So receiver motion is down, right? So put buyer benefits when the price goes down. A simple way to remember. I'm sharing it with you. You might find it funny, but it helps in retention of this simple thing. Now we will talk about how to place an order. Okay, here I'm not trying to talk to you about a complex strategy where I'm combining multiple options, okay, and trying to make a technical analysis based trade or a fundamental analysis based trade. That is, you can say an advanced step. But before that, you have to take the baby steps how to buy one option. Okay, so I will take you to zero the screen, right? And as you can see, this is how the zero the screen looks like. Here I can enter my companies, or I can enter my options or futures. For example, if I want to buy, say, Infosys, I just type Infi. Okay, this is how Zerodha works, and you can see Infi is trading at 1560. You see this market depth, click on market depth, and you will see Infi high today was 1576, low was 1559, quite a small range today, right? So this is about Infosys. You want to see the chart, you can just click on the chart will open up, right? And you can see the chart. So you can put some studies, right? You can put some moving averages. That goes into technical analysis, which is out of the syllabus for this session. So just wanted to show you. Now let us look at the main thing, what we are trying to see, options. Okay, so firstly, how do you search for an option? Say for example, you are interested in buying, we discussed ITC, right? So you are interested in buying an ITC put option. Okay, first let's see ITC underlying price. Okay, because the value of the option depends on the underlying. So ITC is trading at 203 rupees a share. Okay, next thing is, I want to buy July option, which is close to 200. Okay, so what do I do? How do I understand which option series are available? Okay, I simply go here, I go to NSE option chain, right? The option chain opened up. I want to see what all strikes are available, right? So I just type ITC here. There you go. Expiry 29th July. And you can see the strikes available, right? So as you can make out, the strikes are in increments of 2.5. Is that clear? So 2.5 is the increment at which the strikes are available. So 203 is the strike, right? So the nearest strike to 203 is 202.5. So this is nothing but your at the money call option, if you guys remember. Okay, so basically we will do a quick revise here on the option chain. You're seeing calls on the left side, puts on the right side, right? So my question to you is a 200 call option, does the 200 call option have intrinsic value today? And the answer is the current share price is 203, right? 200 call option, does it have intrinsic value? It does have intrinsic value. Why? It has 3 rupees intrinsic value. If it had to expire today, the spot is above the strike, so it is an in the money option. So you can see all the in the money options are on this side, above side. You can see the colored side, and this side are the out of money options, right? And this one or this one of the two is at the money. So 202 in our case is at the money option, right? So 210 call option, is it in the money or out of money? 203 is the spot price, 210 is the strike price, so it has no intrinsic value if it expired today. It is an out of money option in the call side. Let's look at the put side. Is 195 put option out of the money or in the money option? Spot is 203, strike is 195. Put option only has intrinsic value if the spot is below the strike, spot is above the strike. 195 is the strike, 203 is the spot. Out of money option. You can see all these in white are out of money options, put options, and all these are in the money put options, right? So all of these options are traded. So I know it's an increment of 2.5 for each strike price. So let me see, I want to buy a 200 put option for ITC. I believe ITC will fall down. Okay, so what do? I say ITC, I say 200 put option, and automatically the search gives you. So ITC July 200 put option, right? I just click on this one. This is nothing but your ITC July 200 put option. What is the price for the put option? 2.4. So how much premium do you have to pay to buy this 200 put option? As you simply go to buy or sell. If you want to sell the option, you go to sell. If you want to go to buy, if you want to buy, you go to buy. I click buy. You can see the quantity given is 3200. This is the minimum lot size required, okay, for buying this option. If I just say up, you see it doubles, 6400, then 9600. No number in between the two is allowed. You can buy 1 lot, 2 lots, or 3 lots. So what is the premium required? 3200 into 2.4. Okay, that comes up to, here Zerodha does a beautiful calculation for you. You don't have to worry. 7680. That is all you have to pay to buy that option. Is that clear? Now let us look at selling of the option, right? If I have to sell the same option, right? In this case, if you will remember from, I think, the second video or the third video, we discussed that selling of the option, it requires margin premium to be blocked or deposited with the broker. Because if the option goes in the money and you square it off, you have to owe the buyer of the option whatever the profits are there. Correct? So here you can see margin requirement is 1,20,000 rupees. Okay, so you will receive the premium of 7,600, whatever that number was, but till so much time that the trade is active, so much money, so much margin will be blocked by Zerodha. Why are they blocking so much margin? Say for example, tomorrow ITC falls, stock falls by 10% in a day. It can happen. Okay, so suddenly you see the loss is 20 points, right? So 20 into 3200. Okay, so that's 64,000 rupees will be your loss. Okay, so from that margin blocked, Zerodha will be able to pay the end buyer. Is that clear? So this is why option shorts are costlier. Now there is something called as market depth, which gives you an understanding of bid ask kind of ideas. Okay, in blue here you can see bid, and in red you can see ask or offers. Okay, bid means you're bidding, so bidders are people who want to buy, and offerers or basically are people who are willing to sell. Okay, so if you want to buy something, what do you want to buy? You want to buy it cheap or you want to buy it costly? You want to buy it cheap, right? So 2.4 is the going rate, but 2.45 is the seller is there. Okay, the increments are always 0.05 in this case, right? So I can simply go buy, okay, and I can say limit, okay, and I can say I don't want to buy for 2.4, I want to buy for 2.35, okay, and I can say buy. Okay, of course markets are closed right now, so it is not allowing me to place the order. So this is how you can place a buy order for a price you like. Similarly, if you want to sell, do you want to sell something for costlier or you want to sell something for cheaper? You want to sell something for costlier. Okay, so I want to sell for say 2.5 and I press sell. It'll give me the same error again because markets are closed. Of course, if I believe that this ITC stock price is not going to fall, if it's maybe about to rise, I don't mind selling for even 2.4. If I put 2.4 and I press sell, and if the market was on, my order would have immediately been triggered. Why? Because there is somebody directly willing to buy at 2.4. You can see it here in the market depth. Is that clear? Great. So this is one thing. Now let us look at the index options. Now if I just type Nifty, okay, and I put say for example 15,800 call option. Now you can see here you've got a July call option. Only July means it is July end. You've got 1st July, which is today, so this option is expired. Okay, 8th July, okay, then 15th July and 22nd July. And the July month option means it is 29th July expiry. Hope that is clear. So we will just put all of these, okay, 15,800 July 15th 15,800 July call, 22nd was it? Yep, right, and 15,800 July call option. So this becomes part of my watch list on the left. Okay, if I want to take an action, I can take an action. As you can see, 15,800 call today is expired, and today was the expiry day, and I am recording after market hours, so it has no intrinsic value. It is at 0, right? Because it is out of the money option, right? Spot is 15,700, 15,680 and strike is 15,800. So whoever has sold those options has pocketed all of the premium. Next, if you can see, 15,800 is a strike, but one is for 15th July, next is for 22nd July, and the last one is for 29th of July. And you can see the nearby expiry one is the cheapest and the farther from expiry one is the costliest. Is that clear? There is a reason for this and we have discussed the reason. To understand more, please do consider taking up the course on Greeks. It will really open up your complete understanding of options, right? So now with only index options, okay, once again I will repeat an important information. Do not hold stock options by which are closer than 1 week to expiry, right? Because if they're in the money, the broker will start asking for a larger margin, and it'll start blocking more of your money, and if at all it expires in the money, you have to actually arrange for delivery of the shares, whether it's buying or selling. Okay, so ensure that you do not trade stock options which are closer to 1 week to expiry. But index option you can trade up to expiry because there is no delivery clause. Okay, so in this case, if you can see, there is one thing I would like to show you guys. I showed you a limit order, right? But in Nifty cases, you can place market orders. Okay, same with Bank Nifty. Okay, say Bank Nifty, say 34,000 put option. Okay, and let's say, oh, I spelled it wrong, and I say 15 July. Okay, I can place a market order. What does market order mean? Market order means that the broker will ensure that whatever the least costly selling price is, it will buy at that price. Okay, the reason why index which are widely traded, okay, 15,800 will have very high OI. OI data is over here. See, massive OI. Okay, and sorry, this is expired, so you can see 15 July, it has big OI, right? And you can see the difference between the bid and ask is not very high. Okay, this is showing high because of 2 points. It's significant because the markets are not open anymore. If the markets are open, you would see that there is very high convergence in the price. So you can actually place a market order without too much of a risk, okay, for buying or selling, right? So market orders, you don't have to specify what price you want to buy or sell, right? You simply say market order. It will, in the case of a buying, it will buy the least costliest, and it will in case of selling, it will sell at the highest possible bid level possible, right? So this is something that you guys can do. This is how you buy and sell options. Once you have bought or sold the option, it will show under the positions tab. Okay, if you want to exit the option, very similar to this button here, you will have that button there, and you click on that and you press the exit button. Okay, once you press the exit button, for example, say you had bought the Nifty July option for 15,800. Okay, so essentially putting the exit button is like pressing the sell button here. This kind of a box will come out. It will look exactly the same, right? So you have to define the price at which you want to exit the trade. So there are two types of exit you can do. One is you can define a target, because you're a purchaser of an option, you want the price to go up. Okay, for example, you want to exit it when the price goes to 200. Okay, you can then say sell. Is that clear? Second thing you can do is you can say that I know that if the price starts falling, okay, if the price starts falling, I'll start making a loss, right? So you don't want to make a loss, or you want to make a measured loss or a calculated loss. Okay, so you're saying that okay, 165 to 200 is the target I have. Okay, you placed your target order. So whenever if the option price goes to 200, the exchange will automatically trigger your order and your option will be sold off, and that 35 rupee premium you will get to pocket. So you're saying 35 is my risk reward, I will take risk of 15 points. Okay, so you want to wait for no longer than 150. If the price comes below 150, you want to exit the trade. You will take a 15 rupee loss. Okay, so this is basically called squaring off before expiry. Every day you can do it, right? How do you place a stop loss? Okay, you want to stop your loss. Okay, you can simply say click your stop loss. Okay, and you can place your trigger price. Okay, you can say that okay, whenever the price comes to 152, place my stop loss at 150. What this means is that only when the option price comes to 152 or below that, the exchange will place an order for 150. Alternatively, what you can do is stop loss market. What that means, see here, it's not stop loss will give you a fixed price it will put out. But a stop loss market would mean that if I place 150 and say you have bought a call option, Nifty starts falling down, so call option value will start reducing. So you have placed a trigger, stop loss market trigger for 150. What that means is whenever the exchange sees that price has come to 150, it will exit the trade for whatever is the next best buying price. Okay, so the next best buyer might be at 147, so it will sell it off at 147. So you might have to see a slight loss, but in case of Nifty and Bank Nifty, stop loss market is quite reasonably fine. In case of stock options, you may want to place a SL stop loss with a fixed price. Okay, and you have to monitor it very carefully. So in the case of a stop loss market, it's very reliable because you know that you will get your order fulfilled. But in case of a stop loss, say for example you put a 150 stop loss, trigger price at 152, so you want to sell at 150. Market fell so rapidly, suddenly the price is now quoting at 140. What this means is that your order with the exchange means you will only sell at 150, right? Whereas this means you will sell at immediately. Once 150 is reached, you will immediately exit the position whatever the next buying price is, whether it is 140 or 149.9, right? So stop loss market orders gives you peace of mind, whereas stop loss order doesn't give you peace of mind if suddenly rapid changes happen, but they don't take away too much of loss if you're able to monitor your trade. So this is how you exit a trade by putting a target and you put a stop loss. This is in case of a trade you have purchased. In the case of a trade that you have sold, you have shorted an option, when you press the exit button from your positions list, a buy kind of a box will come up, right? So very similarly, when you are shorting, you want to buy it for lesser, right? So your target will be higher than the your target will be lower than the uh, existing price. So existing price is 165. Say that you want to exit this trade at say 140. So 25 rupees you want to profit. And if you want to have a stop loss, say 180 is your maximum. Just giving an example, 180 is the maximum risk you're willing to take. So your 180, if the price goes above 180, you will happily exit the trade, right? So just giving a quick idea and tutorial about how you can buy or sell an option.